Okay, so we are beginning with the first year, which is 2021. So we'll do, I think 2021 was just two sittings, May and November. So we'll start with the May one, and then we'll look at the November one as well. So let's go to question number one. So this one there, Madam Rejoice, I think the only lady in our midst. Can you read question one for us?
Okay. Question one. We are doing July, right?
I
Hello.
think May 2021.
May. Oh, okay.
I think that's what I've highlighted in blue. So
Hmm.
that's question 1A.
Oh, okay. So fundamental principles require that a member of a professional accountancy body behave with integrity in all professional, business, and financial relationships, and strive for objectivity in all professional and business judgments. Objectivity can only be assured if the member is and is seen to be independent. Conflicts of interest have an essential bearing on independence and the public's perception of the accounting profession's integrity, objectivity, and independence. The following scenario is a press report on a multinational firm of accountants. The regulatory body directed a partner in a firm that he must resign because he was in breach of the regulatory body's independence rules. His brother-in-law was the financial controller of an audit client. He was informed that the alternative was for him to move his home and place of work at least 400 miles from the client's office, even though he was not the reporting partner. This made his job untenable. The accounting firm saw the regulatory body as taking its rules to absurd lengths. The multinational firm announced proposals to split the firm into the following areas: audit, tax, and business advisory services, management consultancy, and investment advisory services required in relation to integrity, objectivity, and independence. Discuss the impact the above events may have on firm. So that's for 10 marks.
Okay, thank you very much, Madam Rejoice. Okay, so
Or should I read it?
I think we'll do the B later on. So Okay, so let's take it one after that. So 1A is about I think when you read the case, you have issues about independence, integrity, and objectivity. So we are being asked to discuss the impact of the events above. How it's going to have what do you call it? The impact is going to have on public perception about the multinational firm of accountants. So I don't know, dear colleagues, what do you see? Or we should go straight ahead into the solution and see what was given there. CA Same. Sir James. Okay, so because of our timing, for me, okay, Sir James, if you can go ahead if you wanted to say something.
Oh, please go ahead, sir.
Okay, CA Same, are you now available?
For this one, they gave us in relation to integrity, objectivity, and independence. So, if I was the one behind this question, what I'll start with is to explain my understanding, something small, my understanding of integrity, objectivity, and independence.
Okay.
Then move forward to discuss the impact of the above events on public perception. So, public perception of the company when it comes to integrity, when it comes to objectivity, and when it comes to independence.
Okay.
I think maybe that's how I'll structure mine.
Okay.
So to start with integrity, when you talk of integrity, it has to do with ensuring that you are not associated with any misleading or false information.
Okay.
Then objectivity is making sure that judgment is not impaired.
Okay.
And independence is independence and objectivity. How we like the difference? And then somebody should help me. Objectivity is like you are following the rules, making sure that your judgment is not impaired. Or I think that one has to do with more with your self-interest. Independence too follows closely. I don't know the difference.
Okay.
So after giving the explanation of this, then you go into the case and discuss issues that relate to these three things that you've been given.
Okay. So for me, when I read the case, I think I get major highlights like the point where we are being told one of the partners is a brother-in-law to the financial controller of the audit client. Okay, so that one is key. It will be very important for you to explain if indeed the partner's relationship with the brother-in-law as a financial controller in a way would affect his independence, objectivity, and integrity. But if you continue, I think there was a point made that he was not the reporting partner, right? So if he's a member of the accountancy firm or the multinational firm, but then he's not the specific auditor engaged to provide or a report on the opinion. So I think that point is where he said, even though he was not the reporting partner. So it means the independence of the audit firm, right, cannot be compromised because the said person who has a relationship with the financial controller, it's not even, it has no business with the audit process, right? But then the business, the regulatory body also made some resolutions that he should move his office far away from whatever. Anyway, let's go and read the solution and see some of the things discussed. Okay, so I'm putting the solution line by line so that you can. Okay, so question 1, solution. So the point is that it is important that auditors are and are seen to be independent. Independence is at the heart of auditing profession. As auditors,
Please, the solution screen is not showing.
oh really?
It's showing now.
Okay. I hope it's okay now.
Sorry, it's showing. Sorry, it's showing. Sorry.
Okay.
Zoom in, sorry.
Okay. So they pick the point about objectivity, and they say a family relationship between an auditor and the client can substantially affect the objectivity of the auditor. So auditors are advised not to build close personal relationship with audit clients and should not audit a company where a family member is employed. So I think the point where his brother-in-law is a financial controller. But then it goes on to say, where a family member is employed in a capacity that is sensitive to the account, for example, in the finance department. So it means that even if you are going to audit a company and your relation is not in a sensitive position, then your independence and objectivity is not compromised. For example, if the person is a cleaner. Well, it continues to say, this is not prohibited by law unless the auditor's partner is an employee of the company. I don't know if that makes sense. Unless the auditor's partner.
No, sir. No.
So what does that mean?
Unless the audit partner is an employee.
So it means that if you are going to audit
my wife.
Oh, I'm struggling to hear somebody. Somebody is trying to talk, but
I said the partner is wife or husband. Partner, as in the spouse.
okay. Okay, so it means that if it is your wife or husband, that one there is problematic. The law prohibits it. But maybe a brother-in-law, whatever, a senior brother, whatever, that one the law does not really frown upon on that. But however, the person should not also be occupying a sensitive position. Okay. In this instance, the partner was not the reporting partner for the audit client. So you see, they are trying to tell us that this person who has a brother-in-law there is not even the reporting partner. Okay. So it says, according to generally accepted ethics practice, the firm appeared to be independent of the audit client if the related partner did not have anything to do with the audit. Okay, so in the public or the public perception will be that, of course, the auditor is not even a partner to the audit that is going to be conducted to the company where his brother-in-law is a financial controller. So there's nothing nothing of independence issues here. Okay. So I think that one is clear. Resolution. It says the regulatory body required the auditor to move 400 miles. This presumably implies that the partner was requested to change offices within the firm he employed. However, given current levels of computer networking and other communication common in business, this would appear to be an arbitrary destination. So it means that the directives given by the regulators didn't make sense, because moving away from the business physically does not curtail communication. The person could have still communicated. So I think that was, it says, as a partner in an office, Glasgow could have similar access and influence over audits carried out by a firm as a partner in London. Okay, so the physical movement 400 miles didn't really make sense. Okay, now the next one is about independence in appearance. However, in this situation, the regulatory body to be concerned that the public will not perceive the distinction between a partner and a partner who reports on a specific engagement. This may or may not be fair. Arguably, it is only in publicizing the problem that the public is likely to have a perception at all. Also, given the comment made about modern communications above, the public is unlikely to be convinced that moving a staff member to a different office will solve this independence problem if they perceive that there is one. Okay. Split of audit fee. The decision of the firm to split into three divisions could enhance the public perception of the independence of the audit department. While there might be underlying skepticism about the reasons behind the split, the underlying benefit for objectivity still exists. However, the move would respond to the requirement of the new Companies Act, which prohibits audit firms from offering other services to an audit client. So you see, as I'm reading this suggested solution, I'm not getting any sense. So, well, like Sammy said, if I'm to write in the exams, I think I'll speak about one, the fact that the partner has a brother-in-law, but fortunately, he is not a reporting partner. It means he wasn't even part of the audit process. So his independence, the question about his independence is baseless. And then two, the regulatory body asking them to move offices 400 miles would not in a way ensure independence or otherwise, because they could have communicated via other means of communication, either via WhatsApp, whatever. And then the accountancy firm also deciding to split the firm into different divisions creates a public perception that then maybe they have issues of independence. That's why they want to divide the firm into several units or departments. Okay, so I think for us, we have to build the understanding around the case. As for the writing, we can use our own English and write something. Please, any comment on this before we move on? Sir Francis, you are welcome.
Thank you.
So any comment or we are okay? Okay, so it seems we are okay. Then let's go to question B. Okay, so B says your audit client, Isuo Yeboah Limited, has recently hired an internal auditor to deal with increased regulatory requirements. Afra Kumah, the CEO, has indicated that she believes the presence of the internal auditor will dramatically reduce the work that your audit firm will have to perform. She anticipates that this will have an impact on the audit fee. You are required to draft a report indicating factors that will influence the extent to which external auditors will rely on internal auditors' work as per the requirement imposed by the International Standard on Auditing 16. Okay, so this question for me, I feel that it's more about to what extent can an external auditor rely on the work of an internal auditor, or what will be the guarantee or the basis for relying on the work of an internal auditor? The first thing that comes to mind is if the internal auditor is independent. And if he's independent, then factors like his employment, conditions determined by management or otherwise. Then number two, apart from his independence, does he have the requisite skills and expertise to do proper, audit of internal controls, etc. Then maybe the third one I'll add is if he's certified, if the person is skilled. Okay, somebody might be skilled but not certified. So if he's certified and belongs to a professional body, that will also give the external auditors a basis. Yes. Prof. Francis, go ahead.
Please, so I wanted to ask whether we are discussing everything in the past question, or we are discussing related to what we've done.
Question for the gods, but for me, I think that we have to look at every question, because.
But then he said it in class that we should solve questions related to what we've done in class.
And that could be problematic. How would you know that this we did in class, this we did not do? Because these auditing things, the concepts are so related.
Oh. Okay. Because I was wondering if we did anything on using the work of the internal auditor. I was wondering if we did anything.
Yes, we didn't do, but at least we spoke about internal auditing and external auditing. How I think remember in one of the discussions there was the issue about if you enter a business and you have internal auditors, how do you collaborate with them to do the audit?
Yeah, we spoke about something like that.
Yes.
Where he even mentioned that you have to test the controls, something.
You cannot rely on the information the internal auditor will give. You have to also do your own checks and stuff. So for me, I'm clear in my mind. I don't know which topic, so we would have to read everything. I think that will put us in a good position. Okay. So let's go to the solution for B and see some of the things that the factors that will influence, external auditors to rely. Okay, so this is it. So the question says write a report. So to the CEO from the audit senior date, then the title of the report. So anytime you are asked to write a report, you need to put in these the addressee and the whatever. So report on factors determine the external audit reliance on internal auditors' work. So 1, the status of the internal audit function within the entity and the effect such status has on the ability of the internal auditors to be objective. So one of the factors is you will check if indeed the status of the internal auditors, creates a level of objectivity. Number 2, you have to check whether the internal audit function reports to those charged with governance, that's to management, or an officer with an appropriate authority, and whether the internal auditors have direct access to those charged with governance. So this is more or less like considering whether the internal auditors have some form of direct relationship with management, because there you can sense some form of manipulation there. Okay, so I think that's about the second point. 3, check whether the internal auditors are free of any conflicting responsibilities. For the internal auditor is the one who prepares the payment vouchers and also authenticates it. So you have to make sure that, I think this point is self-explanatory. Check if they are free of any conflicting.
And to add to the second. To add to the second point, whether they report to those charged with governance. So in explaining it, you can add that usually those charged with governance are the board of directors, which is usually independent of management.
Okay, yes.
If they're reporting to the board, then that's a good sign. But if they have to be reporting to management, that's a bad sign.
Okay, yes. Thanks for that correction. So yes, is the board is in charge of governance. Okay. So if you are working with a firm where the internal auditors report to the board of directors, in a way, it means that, like Samir said, it's better than when they report to management. Okay, great. Then you also have to check whether those charged with governance oversee employment decisions related. So again, you have to check whether it's the board who employ or oversee the employment decisions of the internal audit function. Then 3, whether there are any constraints or restrictions placed on the internal audit function by management or those charged with governance. So if there are restrictions, then you should know the level of or the extent to which you rely on it. Then check whether and to what extent management acts on the recommendations of the internal audit functions. Okay, so that is about objectivity. About technical competence, you check whether the internal auditors are members of relevant professional bodies. Okay, I think this one too is good. Then check whether the internal auditors have adequate technical training and proficiency as internal auditors. Then check whether there are established policies for hiring and training internal auditors. Then for the due care, it says check whether activities of the internal audit function are properly planned, supervised, reviewed, and documented. And also check the existence and adequacy of audit manuals or other similar documents, work programs, and internal audit documentation. So I think that you can, when you look at the marks, the B is how many marks? That one too is 10 marks. 10 marks, but I'm seeing here 2 points for 2 marks, 2 points for 2 marks. So what does it? It means that your points should cover all these areas: objectivity, technical competence, then due care. Okay, then we have one here, communication. So you also have to check whether meetings are held at appropriate intervals throughout the period. The external auditor is advised of and has access to relevant internal audit reports. So it means that one of the factors you can also consider is if internal auditors, hold meetings with the external auditor, okay, and also maybe you have access to relevant internal audit reports, and you are informed of any significant matters that come to the attention of the internal auditors. Okay. So I think you can pick maybe 2, 2, 2, 2 for your 10 marks. But I think it's clear, right? The factors you have to consider. So you have to check whether they are competent. That's about their technical competence. You also have to check whether they belong to relevant professional bodies. You have to check if employment decisions are taken by either the board or those charged with governance or management. So I think these points are meaningful. Please, any comments? No comments? Okay, no comment. Let's go to question 2. So question 2 is, well, let me say that I have 5 minutes for the first meeting to end. When it ends, immediately we can rejoin to continue. So I don't know if we have to hold on for question 2 or less. Okay, let me read question 2. Oliso Private Company has been operating in the manufacturing sector for over a decade. One of its major products is manufacturing equipment which can reduce toxic emissions in the production of chemicals. The company recently employed a new marketing manager who introduced a series of marketing initiatives. This has resulted in significant growth of the company since the appointment of the marketing manager. One of the initiatives is the warranties that the company gives to customers. Okay. The company guarantees its product for 3 years, and if problems arise within the period, it undertakes to fix them or provide a replacement for the product. You are the senior manager recently engaged by Integrity Audit Consult, responsible for Oliso Private Company Limited audit. You are performing the final review and you have come across the following issues. Issue number 1, receivable balance from Obe Company Limited. So it means that Oliso Company has some material receivable balance due from this customer named Obe. Your team reviewed the aging of this balance and found that no payment has been received from Obe Company Limited for over 8 months. Oliso Private Company, however, would not allow this balance to be included in the list of balances circulated. So it means they are hiding this transaction. Instead, management has assured your team that they will provide a written representation confirming that the balance is recoverable. Okay. Warranty provision. The warranty provision included in the statement of financial position is material. So they have been making provisions for the warranty they give to their customers. The audit team has performed testing over the calculations and assumptions, which are consistent with prior years. The team has requested a written representation from management, confirming the basis and the amount of provision. Management is yet to confirm acceptance of the need to issue this representation. Now, question required. Recommend 3 audit procedures to validate the accounting estimate. So what procedures will you do to validate the accounting estimate? Well, straightforward, let's go into the solution, or you want to talk around it before we go on?
Sir, you can use the method for evidence gathering, right?
Okay, the methods for evidence gathering. So be specific. Number 1. Okay, so let me use the 1 minute to read. So it says 1. The auditor procedures the auditor should adopt in respect of auditing the accounting estimate. 1. Inquire from management how the accounting estimate is made and the data on which it is based. So you have to ask management to provide data as to how they came about this accounting estimate. That is 1, which is meaningful. I think, please, the meeting will be ending soon. When it ends, you rejoin with the same link. Okay. Determine whether events occurring up to the date of the auditor's report provide audit evidence regarding the accounting estimate. In fact, some of the points are, when I read them, I want clear points that you can easily remember. This one says, test the operating effectiveness of the controls over how management made the accounting estimate. Review the method of measurement used. I think that one too. So what method did they use to calculate the estimate?